Welcome to today's Daily Brief. We're diving into an explainer that's absolutely crucial for anyone keeping an eye on the broader economy right now. We're talking about the macro forces driving the gold market. And hey, we're not just looking at shiny metals here. We're figuring out how you can actually use these forces to strategically defend your portfolio against this ongoing monetary degradation we're all seeing. Okay, let's look at the agenda. First up, the monetary degradation problem. Second, how global deficits are driving gold. Third, we'll look at gold as a strategic shield. Fourth, physical versus paper gold. And finally, number 5, buying the gold dips. Let's get right into it. So starting with part 1, the monetary degradation problem and why we absolutely must invest defensively. Take a look at this quote. It hits the nail right on the head. The force that drives good speculators is not to make money. It is to defend against monetary degradation and inflation. You know, investing in today's environment, it's really no longer just about aggressively chasing alpha or trying to outsmart the market for a quick buck. It's a fundamental defense mechanism. I mean, when inflation is silently eating away at your purchasing power, sometimes at a pretty staggering rate of around 8% a year, you're basically forced to speculate just to tread water. Your primary goal has to shift. It's not just about growth anymore, it's about defending what you already have. Moving on to Section 2, Global Deficits Driving Gold, the Macro Imbalances. Now, let's zoom out a bit and look at the contrast between the two biggest economies on the planet. Over in China, you've got heavily compressed domestic demand. What does that mean? It leads to a massive, massive pool of national savings. And all that capital is out there, actively searching for deep, liquid global markets to park itself in. Then, on the flip side, you have the United States. The U.S. is operating with this persistent, giant fiscal deficit. They have to constantly issue public debt and rely on endless liquidity injections from the central bank, really just to keep the whole debt bubble from popping. So, when you combine China's massive savings looking for a home with the U.S.'s practically endless money printing, well, you create the absolute perfect storm for strategic, highly liquid assets, namely gold. Which brings us to Section 3. Gold as a strategic shield, reducing portfolio volatility. So, let's talk about the actual tools you can use. We want to move past abstract concepts and look at specific instruments, like an ETC, or exchange-traded commodity. Now, unlike some paper derivatives out there that just kind of track the price of gold, a really high-quality ETC, like the one under the ticker 4GLD, for example, is backed 100% by actual physical gold. It's sitting right there in a segregated vault. This is a game changer because it gives you the direct exposure of the physical metal, but with the total ease of making a standard stock market transaction. And having that kind of strategic allocation to gold fundamentally reduces your overall portfolio volatility. But honestly, the real magic here is the deep liquidity it offers. Imagine for a second, geopolitical risks suddenly spike, say conflicts flare up in the Middle East. Overnight, massive institutions or even entire nations need cash immediately. Gulf nations dealing with disrupted oil revenues often have to raise capital on the spot. Because gold is so deeply liquid, it's almost always the very first thing they sell. And ironically, this panic selling causes these temporary, transient dips in the price of gold. But remember, the long-term macro trend is still upward. So those dips, they aren't trend reversals. They are actually your buying opportunities. All right, Section 4, Physical versus Paper Gold, Structuring Your Defense. As an investor, you've always got to navigate real-world trade-offs, right? Let's contrast the tangible safety of physical gold, think of something like a Krugerrand coin, against the super high liquidity of a specialized ETC like that 4GLD we mentioned. Now, physical gold is great because it has absolutely zero counterparty risk, but it definitely comes with high storage costs, transaction fees, and let's face it, it's just harder to sell quickly if you need cash fast. Paper gold, on the other hand, trades instantly, exactly like a stock. Sure, there is a very slight counterparty risk, but if it's backed 100% by a physical vault, that risk is heavily, heavily mitigated. Actually, a lot of defensive investors end up using a combo of both. They'll hold some Krugerrands for that absolute offline security and use an ETC for liquid, tactical moves. Let's touch on the cost of that liquidity for a second. The 4GLD ETC carries a management fee of 0.39%. Now, if you're used to ultra-low-cost passive ETFs, that might sound just a bit high. But here's the kicker, it's widely viewed as a totally acceptable premium. Why? Because the notes of this specific ETC can actually be converted directly into 1 gram of physical gold. So you're essentially paying that 0.39% for the ultimate flexibility. You get the fast-paced liquidity of a stock, paired with the guaranteed security of convertible physical metal. Okay, almost done. Section 5, buying the gold dips and leveraging market volatility. Let's take a look at this timeline because it reveals a really predictable pattern. Even when we are in the middle of a massive macroeconomic bull market for gold, we still see significant intra-year drops. I mean, look at this. We saw a 17% drop back in 2022, an 11% drop in 2023, and 8% in 2024. And the data models actually project structural drops moving forward too, like 9.5% and 7.5% drops in 2025, and potentially a huge 27% drop in 2026. Now, human nature dictates that when you see an asset drop 10 or 20%, you want to panic, right? But the data clearly shows us that these are routine. They are highly predictable buying opportunities caused by those exact liquidity squeezes we talked about earlier. And they're all happening within a very secure long-term upward channel. So if there is one key takeaway I want you to internalize today, it's this. Volatility is a tool, not a threat. Let me say that again. Volatility is a tool. Remember, when you're trying to defend your money against an 8% annual drop in purchasing power, standing still is a guaranteed loss. When the price of gold suddenly drops because, say, some foreign nation needed to liquidate a bunch of assets on a random Tuesday, that volatility becomes an asset you can leverage. It literally allows you to acquire your defensive shield at a discount. It is absolutely not a risk you should fear. I'll leave you with this thought as we wrap up today's explainer. These global imbalances, they aren't going anywhere. The deficits are structural, and those central bank liquidity injections are practically guaranteed to keep flowing. So, take a moment and assess your own financial defenses. How are you positioning your portfolio for this next wave of central bank liquidity? Do you have the right tools in place to actually turn market volatility to your advantage? Think about it. Thanks so much for joining me on this daily brief. Keep learning, stay focused, and I will see you in the next one.